Okay, welcome to the next lecture. Today we're going to talk about firm production decisions. So last time we had a discussion of net present value and project valuation. We talked about and actually derived the time value of money. We talked about how we can use that concept in a process called discounted cash flow analysis, which is where we take future costs and revenues from a project, future profits from a project, and we, in some ways, devalue that flow of money out into the future, and the extent to which we devalue that the profits out into the future depends on how many years from now we're talking about. So profits further out into the future are discounted more, and what that effectively does is saying that we place foundationally a different value on money that we have today versus out in the future. Money and profits that we experience today are worth more than profits that we experience out into the future. And all of that led into a final discussion of the single metric called net present value that we could use to evaluate the economic viability of a project. Remember, the rule of thumb was that if you had a net present value greater than zero, that might indicate a project that's worth pursuing. More importantly, net present value is actually used to compare two different projects side by side for an apples to apples comparison. So, in general, if we wanted to put that in layman's terms, the first lecture as part of the finance and economics bootcamp, we talked about basic accounting and project finance. So, where a utility would get money to build a power plant. Last time we talked about if they could get the money, should they build the power plant? So what metrics do they use to evaluate whether a particular project is worthwhile as an investment? And today we're going to talk about something a little bit different. So the quasi-exam questions for today are: what types of costs are incurred during production? How much of a product should a supplier produce, and how do changes in input costs and market prices change both of these? So I'm going to refresh your memory in terms of the formal expression for net present value here. Remember, this Greek symbol just means to add a bunch of things up, and what we're adding up is the expression to the right of that Greek symbol, so CT divided by 1 plus R to the T. And we're adding that up for every single possible value of t. So from t equals 0 all the way up to some large value t. And so this should look pretty familiar. It looks a little bit like our discussion last time of present value and future value and the relationship between them. In general, our formula for that was that the present value is equal to the future value divided by 1 plus R to the T. This looks a little bit like that. We can say net present value on the left-hand side is the sum of all the discounted future values, where the future value here is CT, or net cash flows in some sort of future year. So that's what we talked about last time. Today we're really going to sort of do a deep dive on how we would calculate CT, how we would arrive at values for that. In most of the previous examples that we did last time, future values or future profits were fixed. Just as a simplifying assumption, we assumed, for example, in the power plant example, that they earned the same annual profits every single year, and that's not really very realistic. So we're gonna talk a little bit more about what might control net cash flow or profits in each year. So let's start with sort of a foundational assumption, which is that the goal of a firm, the goal of an electric utility, et cetera, is to maximize profits. And so we're going to define profits as the difference between revenues and costs. So revenues would be money coming in, costs would be expenses or money going out. So revenues are a product of two things, at least in this simplifying assumption or the simplified case. The number of goods that you produce and the price at which you can sell each one of those goods. And so we're going to assume today throughout that the price is known. We're also going to assume that the number of goods that we produce, or the number of units, is somewhat unknown. It's a decision variable. In other words, if we're trying to maximize profits, the amount of profits we can produce is itself a function of the number of units that we choose to produce. And today we're really going to focus on some of the sort of classical microeconomic theory behind how to choose the number of goods a firm should produce, considering the fact that we have this objective of maximizing profits. So another simplifying assumption that we're going to make, and this is shown at the bottom here, is that we're going to assume that the number of units or goods that we produce as a firm does not impact the price. And so you might kind of wonder how that could even happen, where the decisions of a single firm about how much to produce can control the price. And we're going to get to what impacts market prices next time in the next lecture. But for now, just know that in some cases, in certain markets that don't have many participants or don't have many suppliers, the decisions of an individual supplier can influence the price, and we call that market power. But we're going to assume, again, for all intents and purposes today, that these are not related, right? So that the number of goods a firm produces cannot impact the price itself. These are independent. Okay, so that's revenue. So revenues is the number of goods you produce times the price at which you can sell them. If we're thinking about profits, profits equals revenues minus costs. We also have to think about costs. And we're going to talk about two different types of costs today. Fixed costs and variable costs. Fixed costs are costs that accrue regardless of how many units of a good are produced. You can think of this as the cost of keeping the lights on, for example. If you have a factory, it doesn't matter whether you produce one thing or 100 things, the lights have to stay on, so you have to pay that cost regardless. Also, we could also think about one particular fixed cost being mortgage payments on a loan. We talked extensively, or we have so far, about debt financing being a legal obligation. So paying that money when you borrow a large sum of money to finance the construction of some piece of infrastructure, paying that money back gradually over time with interest is a legal obligation that if you don't meet, you have to go bankrupt. And so you could think of the annual or quarterly mortgage payment on a loan as a fixed cost as well. So those are fixed costs, and now let's talk about variable costs. Again, variable costs are ones that accrue proportionally to the number of units that are produced, right? So you could think of, if you were paying factory workers an hourly wage, and each hour of work for a person contributed to a number of units that were produced. So that means that the more units you produce, the more person hours that go into that process, and so you'd have to pay people more. Also, raw materials. So the example for power plants would be fuel costs. The more electricity you produce at a coal plant, the more coal you need. Okay, so that's fixed costs. Again, fixed costs are costs that don't change with the number of units that we produce. Variable costs do change with the number of units that we produce. And we can estimate variable costs as equal to the number of units that we produce times some sort of variable cost rate, right? So if we knew that our variable cost of producing one unit was $10 per unit, and we produce 10 units, then our variable costs are 10 units times $10 per unit, or $100. Okay, so let's do a really simple example here. We're going to assume that we have a factory or a plant, and that we already know the variable cost rate, that it costs roughly costs the power plant $25 per unit to make each individual unit it produces. In terms of its variable costs, and then it has fixed costs of $500. So it costs $500 to keep the plant open, the lights on, the mortgage payment, etc. This is a very simplified example. So we have 4 columns here: the production, or the number of units we produce, the total fixed costs in dollars, total variable cost in dollars, and then total overall cost in dollars. And so you can see in the first column that production of units scales from 0 to 100 all the way up to 500. So we're increasing the number of units we produce 100 at a time. In the second column, we see total fixed costs, right? And so what you'll notice there is that the total fixed costs for operating this plant are $500, and it stays at $500 regardless of how many units you're producing. The third column is total variable costs. So total variable costs, remember, these are costs that accrue proportionally or proportional to the number of units that we produce. So if we produce 0, then our variable costs are also 0, right? And remember, our variable cost rate is $25 per unit. So $25 per unit times 0 units is just 0. If we produce 100 units, then our total variable costs are 100 units times that $25 per unit rate, so $2,500. If we produce 200 units, our total variable costs are 200 units, again, times that $25 per unit variable cost rate, and that gives you $5,000. And sort of so forth and so on. You can go row by row here and calculate total variable cost as the product of the total number of units produced and that variable cost rate of $25 per unit. The last column is total costs. So total cost is just total fixed costs plus total variable cost for each level of production. So in the first case, in the first row, total cost is just our total fixed cost, because we're not producing anything, but we still have a cost that's associated with the fixed cost. So in the first line, the total cost is $500. So 0 plus 500 is $500. In the second row, we're again going to add total fixed costs of $500 to our total variable cost of $2,500. So we get $3,000, and so forth and so on. So each row, the total cost is equal to total fixed costs, $500 in every case, plus total variable costs, which changes depending on the units of production. And so this figure just visualizes that. On the y-axis, we have cost in dollars. On the x-axis, we have units produced. And so at every level of unit production, we can look at fixed, variable, and total cost. So fixed cost is just a horizontal line because our fixed costs are $500 no matter how many units we're producing. Our variable costs, our total variable costs, are represented by the red or pink line. And so you could think of the slope of this line as 25, because for every unit of production we increase, we incur another $25 of cost. So we could describe that variable cost line. Every value of the variable cost line on the y-axis is simply equal to the value on the x-axis times $25 per unit. And then the total cost at every unit of production is illustrated by this green line, right? And so you see it tracks very closely with the variable cost line, but not exactly. There's a vertical difference between the total and variable cost, and that vertical difference is just the fixed cost at every unit of production. So the difference between the green and the red at every point is $500.